Welcome back to Talk Tickers. This is the deep dive where we strip away all that cable news noise and really obsess over the machinery of the market.
Right.
Today, we are laser focused on a single event, something that happened just yesterday. We're looking at the GE Aerospace Q4 earnings call.
A big one.
It is Friday morning, January 23rd, 2026. And look, if you're an investor or trader or just someone who likes watching a good corporate drama unfold, this is the perfect case study.
It really is. I mean, it's one of those classic market paradoxes that drives retail investors absolutely crazy.
Yeah.
You have a company that is, by almost every single meaningful metric, performing at an elite level. They're printing cash. They're selling everything they can build. And yet,
if you looked at the stock chart yesterday, you would think the factory burned down.
Exactly.
We are getting right into the weeds of the ticker symbol GB. And let me set the scene for you properly. Yesterday, GE Aerospace releases their Q4 numbers. By all traditional accounts, they crushed it. They beat on earnings. They beat on revenue. They raised their cash flow profile.
And the market responded by taking a sledgehammer to the share price.
A literal sledgehammer.
Right.
We saw a pre-market drop from around 318 all the way down to 307. And the selling pressure didn't stop when the opening bell rang.
Yep.
By the close of trading yesterday, shares were down nearly 7.4%, sitting at 295.
It's the classic beat and drop. And honestly, this is why we do these deep dives. Because on the surface, it looks completely irrational.
It does.
But when you actually listen to the call, analyze the guidance, and look at the sector context, a very specific narrative emerges. It's logical, even if it's painful.
So that is our mission today. We're going to dissect why a company that is quite literally printing billions in cash saw its valuation haircut by 7% in a single session. We're going to look at the numbers, the expectation game, the mechanics of their supply chain, and, well, we've got a really aggressive trade idea at the end that might just take advantage of this whole situation. But first, let's look at the scoreboard. What did the numbers actually say?
Let's start with the good news, because there was a lot of it. If you're just looking at the spreadsheet, Q4 was stellar.
Okay.
Let's look at the bottom line first. Adjusted earnings per share came in at $1.57. The street, the consensus of all the Wall Street analysts, was looking for $1.44.
So that's a 13-cent beat. I mean, that's not a rounding error.
No, it's significant. That represents a 19% increase year over year. Revenue is the same story. GAAP revenue hit $12.7 billion against a street estimate of $12 billion. That is an 18% jump, again, year over year.
Okay, so double-digit growth on the top and bottom lines.
Correct. But, and this is crucial for you to understand, earnings and revenue are accounting numbers. They can be massaged with accruals and depreciation. The number that really matters, the truth teller in any industrial business, is free cash flow.
The actual cash hitting the bank account. The stuff they can use to buy back stock or pay dividends.
Exactly. And the cash machine is humming. In the fourth quarter alone, they generated $1.8 billion in free cash flow, up 15%.
Okay.
For the full year of 2025, they hit $7.7 billion. But here's the nugget that really impresses me. The conversion rate was greater than 100%.
Can you pause there? Unpack that for me. Conversion rate. How can you have more than 100% conversion? That sounds like magic.
It does, but it's just efficiency. Net income is your profit on paper, but free cash flow is what you keep after you pay for new factories and tools.
Right.
Usually, heavy industrial companies spend so much that their cash flow is lower than their net income. When conversion is over 100%, it means GE is collecting cash faster than they are recognizing the profit.
So they're just managing their inventory incredibly well.
Incredibly well. Shipping engines out the door and getting paid immediately rather than letting parts sit on shelves. It's a sign of elite operational discipline.
Okay, so the bank account is growing faster than the spreadsheet says it should. That's usually exactly what investors are begging for. But here's where it gets really interesting. There was a wow metric in this report that I think got completely overshadowed by the red ticker tape.
The orders.
We need to talk about the orders.
The backlog. This is the single most critical number for the long-term health of an aerospace giant. You can have a bad quarter, sure. But if the backlog is growing, the future is safe.
And it was growing.
Q4 orders exploded to $27 billion. That is up 74%.
74% in a single quarter.
Yes. And that brings their total backlog the total amount of work they have sold but haven't built yet, to approximately $190 billion.
Just pause and think about that number for a second. 190 billion. That's basically the GDP of a country like Kuwait or Hungary, just sitting in the order book waiting to be executed.
It's effectively an insurance policy against a recession. I mean, even if the global economy completely freezes tomorrow, GE has years and years of guaranteed work.
So, okay, let's play detective here. You've got a double beat on earnings and revenue. You have super efficient cash flow. You have a backlog that guarantees work for a decade.
Right.
Why on earth did 13.8 million shares trade hands yesterday, which is 3 times the normal volume, mostly to the downside? Why did the stock plummet 7.4%?
This is where we have to separate the financials from the sentiment. It's the expectation game. The sell-off wasn't about what GE did in Q4 of 2025. It was entirely about what they said they're going to do in 2026.
To guidance.
Specifically, the revenue guidance.
Okay.
Management guided for low double-digit adjusted revenue growth for fiscal year 2026.
Low double digits, so 10, 11, 12%. I mean, in the world of massive industrial conglomerates, then that's actually quite good.
In a vacuum, it's excellent. But you have to remember, GE stock wasn't priced for excellent.
It was priced for perfection.
It was priced for perfection. It had run up significantly going into this print.
Ah, the valuation trap.
Exactly. Before this drop, GE was up almost 9% in just the last month. It was drastically outperforming the broader aerospace and defense ETF, the ITA, and the industrials ETF, XLI.
So it was running hot.
When a stock runs that hot, the whisper number, the unofficial expectation that traders gossip about, is usually much higher than the official consensus. Investors were positioned for an acceleration.
So when management says low double digits, the momentum traders here.
Acceleration.
Acceleration.
Yeah, precisely. To a market that's hyped up on momentum, steady growth sounds like slowing down. Plus, look at the other guidance. Operating profit, $9.85 to $10.25 billion. Free cash flow, $8 to $8.4 billion.
Still objectively strong numbers.
They are. But they weren't the massive raise and beat that the bulls needed to justify a stock price north of $315.
It's like getting an A- on a final exam when your parents expected an A+. You still passed. You're still smart.
But you're definitely grounded for the weekend.
That's a great analogy. And in the stock market, being grounded means a multiple contraction. That's the 7% drop. It's a valuation reset, not a business failure.
Exactly.
So we have a valuation reset. The stock got a little too far over its skis, but let's look under the hood at the actual business operations.
Okay.
Because if you ignore the stock price for a minute and listen to what management was saying about the factories, it sounds like things are finally unclogging. They kept mentioning this flight deck concept.
Flight deck is their proprietary operating system. Think of it as the central nervous system of the factory. It manages the flow of materials, labor, inventory, all of it.
Is this just corporate buzzword bingo? You know, synergy, paradigm shift, flight deck?
I'm usually skeptical, but in this case, the data actually supports it. For the last 2 years, the story in aerospace has just been supply chain hell.
The famous bottleneck.
We have the orders, but we can't build the engines fast enough because we can't get the parts. That was the story.
Right.
Now management is claiming that flight access is finally taking hold. And they gave us a specific data point that validates this.
Okay.
Material input from their priority suppliers is up more than 40% year over year.
Okay, let's unpack that. Why is input from priority suppliers such a big deal?
Well, think of the engine assembly line like a gourmet kitchen. You can have the best chefs in the world, that's GE's workers. But if the truck delivering the filet mignon doesn't show up, you can't serve dinner.
Doesn't matter how ready the kitchen is.
For years, the suppliers, the trucks, weren't showing up with the titanium, the castings, the forgings.
So a 40% increase in material input means the ingredients are finally arriving.
Exactly. And not just any ingredients, the priority ones, the bottlenecks, the golden screws that hold the whole thing up. This tells me that the plumbing is fixed.
And because the ingredients are arriving,
They're cooking more meals.
I saw the delivery numbers were record-breaking.
They were. LEP engine deliveries, that's the engine that powers the 737 MAX and the A320neo, were up 28%. A record.
28%.
Total engine deliveries were up 25%. Even the defense side saw deliveries up 30% for the full year.
That feels like a significant pivot. The narrative is shifting from supply chain purgatory to a pure volume story.
That's the key takeaway. They have the parts, now they just have to execute. And attacking a $190 billion backlog with a functioning supply chain, that sounds like a pretty good position to be in.
But there is another layer to this GE onion that I want to peel back. We always talk about them building engines, but you and I know that selling the engine isn't actually the best part of the business.
Oh, not even close.
The real gold mine is fixing them, the aftermarket.
This is the flywheel thesis, and it's why long-term investors love this stock. Over 70% of their commercial engine revenue is tied to parts and services. It's the high-margin safety net.
That is a staggering number, 70%. So really, GE is a service company that happens to sell engines just to get you into their service ecosystem.
That's it. It's the razor and blade model, but on a massive scale. They sell the engine, sometimes at break even.
Wow.
But then they sell you the blades, the maintenance, the parts, the overhaul for 25 years. And the margins on those blades are spectacular.
And they're doubling down here. They announced they're pouring over $1 billion into their global MRO network that stands for maintenance, repair, and operations.
They are building capacity because they know a wave of maintenance is coming. The Aligned engines are relatively new, but they're starting to hit their first major service intervals.
They need the shop space.
They need the shops open to capture that revenue. If you don't have the slot, the airline might try to go elsewhere or just park the plane.
Speaking of going elsewhere, there was a little note in there about the IATA agreement. It seemed a bit legalistic, something about an open aftermarket. Why does that matter to the average investor?
Oh, it's crucial for protecting their moat. CFM, which is GE's joint venture, renewed its agreement with IATA, which represents the airlines.
Okay.
By affirming an open aftermarket, GE is basically telling the airlines and regulators, look, we aren't a monopoly. We will play fair. We will license third-party shops. We won't price gouge.
Ah, so it keeps the antitrust regulators off their back.
It does. And it signals confidence. They don't need to lock people in with restrictive contracts. They know their service is good enough to win the business on merit.
Right.
Plus, look at the macro backdrop. Airlines are desperate. New planes are delayed across the industry. Thank you, Boeing and Airbus delays.
Right. If you can't get a new plane, you have to fly the old one.
And flying an old plane requires more maintenance. Higher utilization of older fleets keeps that MRO demand incredibly strong. That's the tailwind that protects GE's cash flow, even if the manufacturing side has a hiccup.
So we have a strong aftermarket moat, a supply chain that is thawing out, and a backlog that is practically infinite. Let's circle back to the investor context.
Right.
The stock is down 7.4%. We are sitting at $295. Is this a broken thesis, or is this a buying opportunity?
If you look at the fundamentals, the backlog, the supply chain improvements, the cash flow, the thesis is fully intact. Nothing in this earnings call suggests the business is broken.
Nothing at all.
In fact, operationally, it's better than it was a year ago.
So it's purely price.
It's a valuation reset based on the rate of growth. The market just got ahead of itself. Now, the signals to watch are very specific.
Like what?
Can they maintain that elite delivery ramp without hurting their margins? Will that billion-dollar investment in MRO actually result in more capacity quickly? The market needs proof that the aftermarket flywheel can persist.
Basically, show me the money and show me the margins.
Correct. But if you're a long-term holder, a 7% drop when the backlog is this strong, well, history suggests that usually represents a sale on future cash flow.
All right, that brings us to the part of the show where we take off our sensible analyst blazers, undo the top button, and put on our aggressive hedge fund fleece vests.
Oh boy. Here we go.
It is time for our This Is Not Financial Advice segment. And I have to say this loudly for the people in the back. We are not financial advisors. We are just two voices in your headphones analyzing data.
Please don't do this at home.
Do not trade on this. This is for entertainment purposes only. But if we were pitching a trade to an investment committee based on this earnings call, what would it be?
I've been thinking about this supply chain thaw metric. The fact that priority supplier input is up 40%.
Okay.
The market is looking at the revenue miss and panicking, but they're ignoring the plumbing. The plumbing is fixed.
So how do we play that?
I call this the backlog burn rate arbitrage.
Ooh, fancy title. Break it down.
Here's the thesis. The market panicked over the low double-digit guidance. But that guidance is likely conservative because management knows they can finally burn through the backlog faster than expected.
The bottleneck is clearing.
It's clearing. So the trade is to go leveraged long on GE, maybe via call options, for late 2026.
Okay, betting on the bounce back. But knowing you, there's a hedge. You never just go long.
There is. You pair it with a short on the boutique titanium and alloy suppliers.
Whoa, short the suppliers.
Yeah.
But you just said they're delivering more. If they're delivering more, aren't they making more money?
They are delivering more volume, yes. But think about the pricing power. For the last 3 years, these suppliers have had infinite leverage. Everything was scarce. They could charge whatever they wanted.
Because GE needed that titanium.
Desperately. If GE's supply chain is normalizing into a steady state, the super cycle pricing for those raw materials is about to peak.
The scarcity premium evaporates.
Exactly. It's a classic mean reversion trade. Long the integrator, short the component suppliers who are priced for a permanent shortage. You're betting that efficiency is good for GE, but bad for the suppliers who profited from the chaos.
That is devious. You're betting that GE getting healthy means their suppliers lose their leverage. I love it. It's contrarian, and it uses the data point nobody else is talking about. I have a slightly different angle. I'm looking at that $190 billion backlog and the 70% services mix.
Okay.
I call this the MRO cash cannon.
Oh, God.
This is an income play. The stock dropped to $295. The volatility spike means option premiums are juicy. People are paying a lot for insurance right now.
They are.
You sell put options at the $280 level.
Selling puts. So for the listeners who don't trade options, you're acting as the insurance company.
Exactly. When you buy a put, you're buying protection. When you sell one, you're selling it. You are essentially betting the house that airlines cannot stop flying the CFM-56 engine.
It's the workhorse of the sky.
It is. GE is the toll booth operator. By selling the 280 puts, you collect the premium cash right now. If the stock stays above 280, you keep the cash. Free money.
And if it drops below 280,
then you get assigned the shares at 280. You end up owning the world's best aerospace monopoly at a massive discount compared to where it was yesterday. You own the toll booth on sale.
that is actually not that crazy. It's aggressive, but it aligns with the floor that the backlog provides.
Yeah.
If you believe the floor is concrete, selling puts is a smart way to monetize the fear.
The MRO cash cannon. You heard it here first. But again, please don't actually do this unless you enjoy explaining to your spouse why you own 1,000 shares of an engine maker because a podcast told you to.
Or why you're shorting titanium futures.
Exactly. All right, let's wrap this up. Recap for the road.
Q4 was a beat. Cash flow is massive at $7.7 billion for the year. The backlog is a staggering $190 billion.
Yep.
But guidance was conservative enough, low double digits, to spook the momentum traders, causing that 7% drop.
Supply chain is thawing, operations are improving via flight deck, and the aftermarket moat is as wide as ever.
The drop feels like a valuation reset, not a fundamental failure.
And I'll leave you with this final thought to mull over. When a company has $190 billion in orders waiting to be filled orders that are contractually locked in, does a 7% stock drop represent a failure of growth, or is it just a flash sale on future cash flow? The market votes every day, but the backlog doesn't lie.
The backlog is the truth.
That's it for this deep dive into GE Aerospace. We are Talk Tickers signing off. We'll see you next quarter.
See you then.